Great. Well, thanks, Dan. My name is Roger Lee, and I work at Battery Ventures. I'm lucky enough to be one of the co-hosts of the event, and I'm very grateful that you're all willing to take time out of your busy schedules to be here today. For those of you who have attended the Marketplace conference in the past, or were scheduled to join our in-person event in San Francisco a couple of months ago, this one is going to be a little different. We're still going to have fantastic speakers, and the content will be first rate, but this is a bit of an experiment as we try to do this entire event over video. Please be patient with us if we hit some bumps along the way, but we're confident that this is still going to be a fantastic event. I'm going to get things kicked off with a presentation titled The State of Marketplaces in 2020. Before I start though, I want to take a minute and thank all of you for your support. We could not be here if it was not for you, so please know how grateful we are. In addition, we also want to acknowledge all of the amazing organizations around the world who are working hard to fight the COVID-19 pandemic. In an effort to help them, all profits from this event will be donated to the San Francisco Marin Food Bank and the World Health Organization COVID-19 Solidarity Response Fund. So not only are we hopeful that this event can be educational for all the participants, but we will also make a small dent in the effort to address COVID-19. So thanks again for all of your support. And with that, let's get started. As I said a minute ago, I work at Battery Ventures. We're a venture capital firm managing almost $9 billion. In fact, we just closed our newest fund, Battery 13, which is a $2 billion vehicle earlier this year. We're totally stage agnostic and will happily invest $500,000 or $1 million in the seed stage investment, all the way up to a $100 million pre-IPO growth equity investment. We operate globally with 6 offices around the world. Most importantly, we love marketplaces, and this is my favorite slide. Over the past 10 years, we've invested in over 20 different marketplace companies that we've highlighted on this slide. Our investments range from transactional e-commerce businesses like Wayfair and StockX and Groupon to content businesses like Glassdoor, local services marketplaces like Angie's List, to travel marketplaces like Hotel Tonight, and financial services and exchange marketplaces like Coinbase. Across this marketplace portfolio, we've invested over $375 million. So this has been a big area of focus for us. Most importantly, we will continue to aggressively invest in marketplaces across both Europe and the US going forward. So we are open for business. So that begs the question, why are we investors in marketplaces? Why do we like marketplace businesses so much? The answer is that we look for businesses that change the world, make consumers' lives better, and become extremely valuable. If you look at marketplaces, they've done this in a huge way, and this has generated great returns for their investors. The slide I'm showing here is from the Marketplace conference in March of last year, where we showed how the marketplace index of 40 publicly traded marketplaces had handily outperformed the NASDAQ during the prior 7 years. As you can see, the marketplace index returned roughly 200%, while the NASDAQ was up 158%. However, despite all that value creation and progress, the rest of 2019 was a rough year for many marketplaces across the public and private markets. Everyone from Uber and Lyft as public companies to WeWork, Bird, Lime, and GetAround as private companies suffered as investor sentiment shifted from growth at all costs to a balance of growth and profitability. Many money-losing marketplaces had to quickly shift gears and adjust their businesses to this new reality of efficient growth. You can see some examples from this slide where many of them had to take painful steps in the form of rifts, down rounds, or simply being shut down for good. I think Dara in particular summarizes this mind shift really well. He says the era of growth at all costs is over, and investors increasingly demand not just growth, but profitable growth. However, despite those efforts to quickly change strategy, it was too little too late for many of the public marketplace companies, and the performance of the marketplace index suffered during this time as well. From March of 2019 through October, the marketplace index dropped by over 10% before staging a nice rally at the end of the year and for the first couple months of 2020. Despite the rally, the index still trails the NASDAQ by almost 10%, reflecting the concerns the investor community had in many marketplace companies. And then COVID hit. If you didn't think things could get any harder, you now had to deal with a global pandemic. For many marketplaces that are connected to travel, hospitality, or retail industries, this was a devastating blow. Some of them literally saw their revenues decrease by 30%, 50%, or more in a matter of weeks. For others, it might have just been a glancing strike where their businesses saw a decline of 5 to 10%. And there's some lucky winners as well who saw their businesses benefit, but they are the exceptions. So what impact did COVID have on the marketplace index? The simple answer is not good. The average marketplace company saw their stock price decline by 18% over the past year, with much of that decline happening in the 8 weeks after COVID hit. Needless to say, this has been a very painful period for many public marketplace companies. However, like many things in life, averages are misleading, and that does not tell the full story. There is a wide distribution of returns for marketplace companies during this period, and as hard as it was for many of them, some of them have really shined. As you can see on this slide, the top decile of public marketplaces saw on average a 70% positive return, while the bottom decile was down 65%. Looking back, this was a period of Darwinian separation where the strong marketplaces were rewarded and the weak marketplaces were exposed. So this begs the question, what separated the winners from the losers? Why have some marketplace companies generated such attractive returns while others have struggled and destroyed significant value? I think you can boil it down to one word: efficiency. The marketplaces that run a more efficient business were rewarded, and the ones that run a less efficient business were punished. So if I was a CEO or founder in the audience, the question I'd be asking myself is, what does it mean to run an efficient marketplace? Or how do I measure efficiency? Well, there are many ways to measure business efficiency, but a simple one that most investors like to focus on is the Rule of 40. The way you calculate the Rule of 40 is to add up your revenue growth plus your EBITDA margin. Ideally, those numbers should add up to 40 or higher. If you are, you're running an efficient business. If it's much below 40, chances are you're running an inefficient business. I'm showing a couple of examples on this slide. One example is Chegg. As you can see from the second row down, the company grew 28% last year, and they generated a 13% EBITDA margin. If you add up the revenue growth and the EBITDA margin, you get 41. The counterexample is Uber. They had revenue growth of 26% last year, but they had a negative EBITDA margin of minus 56% for a Rule of 40 of negative 30. Not surprisingly, the stock price performance of these two companies has been dramatically different over the past year. Chegg's high Rule of 40 demonstrated great business efficiency, and they were rewarded with a 4% stock price increase and a revenue multiple of 10.8. I should also mention those numbers are a few weeks old, and Chegg has continued to outperform, and they're now trading at a 15x revenue multiple. In contrast, Uber's negative Rule of 40 number raised many questions about their business efficiency and long-term ability to generate durable profits. As a result, they saw their stock price drop 30%, and they're trading at 3.9x revenue, which is 1/3 of Chegg's revenue multiple. So a high Rule of 40 was a good predictor of stock performance for those two companies, but you might be asking whether a high Rule of 40 correlates to strong performance for all of the marketplace companies. The answer is a clear yes. As you can see on this slide, the average Rule of 40 for the top performing companies was roughly 50. In contrast, the average Rule of 40 for the public marketplaces that lost value was roughly 10. And not only is a high Rule of 40 correlated to stock price performance, it also drives your valuation multiple. The higher your Rule of 40, the higher your multiple. As you can see in this slide, marketplaces that have a Rule of 40 that is above 40 trade on average for 8 times revenue. If your Rule of 40 is between 30 to 39, your revenue multiple is roughly 4.4x. And if your Rule of 40 is below 30, your revenue multiple drops to 2.4x. So the key takeaway for the marketplace entrepreneurs and CEOs in the audience is that the world has shifted from growth at all costs to efficient growth. And as you think about the best way to efficiently grow your business, think about using the Rule of 40 to balance growth with burn. It will give you a simple framework to manage the tension between those two forces. And if you can operate the marketplace at a Rule of 40 or higher, you will be richly rewarded. Your marketplace will trade at a premium multiple, and it should generate great returns for you, your employees, and your investors. Oh, and if you have a marketplace that has a high Rule of 40, a 40 or greater, please give me a call. I would love to invest. Okay, so now you know how to measure marketplace efficiency. The next question is, what do I do operationally to improve my rule of 40? What changes can I make to the business to make it more efficient and increase my rule of 40 number? In the time we have remaining, we're going to offer 3 specific suggestions for things you can do to improve your marketplace efficiency. I wish we had a more creative name, but we're calling this Battery's 3 Rules for an Efficient Marketplace. We will publish others over time, but given the time constraints, we'll start with these 3. The first relates to your sales and marketing organization, and we're calling this the Battery Growth Magic Number. We will define it and explain it in a minute. The second is to encourage you to migrate to subscription pricing, if at all possible. And the final one relates to the operations of your customer experience or customer service organization, and we're calling this the Battery CX Magic Number. We'll define this one soon as well. So let's dive into our first rule, which is the battery growth magic number should be greater than 0. So what does this mean? The way we're calculating this is really simple. At its core, your percentage of revenue growth should be higher than your percentage of sales and marketing spend. For example, if you're growing revenue at 30% per year, but you're spending more than 50% of your revenue on sales and marketing expenses, your sales and marketing function is very inefficient. Conversely, if you're growing 50% per year, but you're only spending 30% of your revenue on sales and marketing, you're getting a lot of leverage out of your sales and marketing, and you are very efficient. So long as this number is positive, you're running an efficient sales and marketing organization. To bring this metric to life, we're showing a few specific examples of public marketplace companies on this slide. You can see Chegg grew 28% last year, but only spent 15% on sales and marketing. This gives them a battery growth magic number of 13, which is strong. Netflix also grew at 28% and spent 13% on sales and marketing, giving them a battery growth magic number of 15, also very strong. Conversely, Yelp grew 8% last year and spent 49% of their revenue on sales and marketing, giving them a battery growth magic number of negative 41. Not surprisingly, Chegg and Netflix traded a significant premium to Yelp, and their stock prices saw strong performance over the past year while Yelp suffered. The battery growth magic number is also a good predictor of public marketplace returns as well. As you can see, the top quartile of companies all had the highest growth magic numbers, which means they ran the most efficient sales operations. Conversely, the bottom quartile had the lowest growth magic numbers, and they had the least efficient sales operations. So how did the best performers do it? What are some examples of things that the most efficient sales and marketing organizations did to optimize their performance? Ultimately, it boiled down to product-led growth versus human-led growth. The more you can engineer growth into the core product experience and the less reliant you are on people to deliver the growth, the better. In the case of Chegg, they've assembled a huge content repository of 35 million textbook questions that all college students struggle to answer. This indexes incredibly well on Google, which drives a lot of SEO, and they have an efficient freemium funnel to convert that traffic into paying users. In the case of Netflix, their recommendation engine drives significant increases in content consumption, which improves engagement, subscriber renewal, and ultimately lifetime value. Yelp, on the other hand, is reliant on expensive and highly commissioned local sales teams. They have over 3,500 sales reps calling on small businesses to sell them advertising, which is an expensive and operationally complex model to manage. So the simple answer is, do your best to build growth levers directly into your product. This is the most durable and efficient way to grow, and it will yield the highest growth magic number. Battery's second rule for running a more efficient business is to migrate to subscription pricing. So what do we mean by this? As founders and CEOs, you need to figure out the optimal way to monetize your business. Many marketplaces use transactional business models where they simply get a cut of each purchase that takes place in the marketplace. eBay is the classic example here, and that's where most marketplaces start. Over time, many marketplaces have migrated to subscription pricing where the consumer pays a fixed fee every month or year to use the service. You can see examples on here for marketplaces like Spotify and Pluralsight, who offer a range of monthly and annual subscriptions. In fact, some companies have started offering a price for lifetime access. The key takeaway, however, is that the more you can shift your business from a transactional model to a subscription model, the better. Not only does it give you better visibility and predictability into the revenue of the business, but it also yields much higher customer retention and higher lifetime value. And the more you can push your subscribers to annual plans versus monthly plans, the better. This slide illustrates this point in black and white. We're showing the retention and lifetime value of monthly versus annual subscribers across 4 different consumer subscription companies, and the difference is dramatic. Annual subscribers retain at roughly 3x higher rates than monthly subscribers, which not surprisingly leads to a 3x improvement in the lifetime value of annual subscribers. The reason for this is very simple. If I need to renew my subscription every single month during the year, it's likely that at some point I may cancel. Even if you discount the annual plan by 30 to 40% versus the monthly option, it's still the right decision from a customer lifetime value perspective. To be clear, many marketplaces are designed to be transactional and don't have the option to run a subscription business model. For those companies, you should obviously stay with your transactional model. However, if you can migrate to a subscription model, and in particular, get your customers to adopt annual plans, it will significantly increase your customer lifetime value and make you a much more efficient and profitable business. The third and final rule in running an efficient marketplace has to do with the customer experience function. Interestingly, there are not a lot of metrics or best practices on customer experience operations. For example, what does it mean to run an efficient customer experience or CX organization? What companies are best in class? It's not clear. In an effort to address this, we've assembled a lot of data around marketplace customer experience teams, and we'd like to propose a metric that we think can help you and your CX teams measure your efficiency. Specifically, we think the best-in-class marketplace CX organizations can generate a 10x return on their CX spend. The way we calculate this is very simple. We look at the net revenue per transaction divided by the CX cost per transaction. If that number is greater than 10, you're running an efficient CX organization. In other words, for every $1 you spend on customer experience and customer support, you generate at least $10 in net revenue per transaction. If that ratio is less than 10, meaning you're spending more than $1 in CX expenses for that $10 of net revenue, that should raise some red flags. To be clear, customer experience is a double-edged sword. On the one hand, you need to invest in CX to ensure your customers are happy and being well served. Not surprisingly, 90% of US consumers consider CX as a factor in whether they want to buy from a particular company. And if you do a good job with CX, customers will spend more per transaction and be a more frequent buyer over time. The challenge is, how do you do this cost effectively? How do you deliver a great CX experience without breaking the bank and ruining your unit economics? The simple answer is it's not easy, and it takes a lot of work. It also really depends on the type of business you're running. For example, on-demand marketplaces tend to have higher CX expenses than marketplaces with scheduled services because the logistics and expectations for an on-demand business are much higher. Marketplaces with higher transaction values also tend to have higher CX expenses than those with lower price points because the consumer has higher expectations for the quality of the service. We don't have enough time right now in this session to break down all the nuances of CX spending and best practices across different types of marketplaces, but this slide gives you a snapshot of how broad it can be. As you can see, we've captured data from 9 different private and public marketplaces and compared their CX cost per transactions. The outputs are really interesting, and it gives you a sense for which companies are running a very efficient CX operations and which ones are not. Without revealing anything proprietary, I can tell you that the companies with a low battery CX magic number, these are the ones on the right side of the slide, tend to have a hard time scaling and are very capital intensive. Conversely, the ones on the left with a high CX magic number tend to be much more capital efficient and scale much more easily. So what separates the winners and the losers on CX? Why do some companies do so much better than others? Similar to the key takeaway in growth, the most efficient companies tend to have product-led CX, and the least efficient companies tend to have human-led CX. Specifically, The best companies invest heavily in their FAQs and customer knowledge bases to enable self-service. They are easily searchable and have very rich Q&A functionality. Most customers, it turns out, really want to figure this stuff out for themselves. You just need to give them the content and the resources to easily answer their questions. In fact, the best companies can actually get more than 80 to 90% of their customer questions and issues addressed through automated, no-touch self-service channels. Conversely, the worst CX performers tend to be very reliant on humans and phone-led support. They have not made the investments to solve the core questions in the product experience, and customers have no choice but to call. Not surprisingly, these companies tend to have high customer churn and low lifetime value. As I mentioned before, there's a lot of nuance to how each marketplace should design their CX and customer service operations, and we'll come out with more content and research on this topic in the coming months. That said, here are 5 key metrics you should be tracking across your CX teams. In particular, focus on number 1, your contact rate. The higher your contact rate, the more worried you should be. The more your customers can get their issues resolved through product experience to reduce the contact rate, the better off you're going to be. Not only will this reduce your CX costs, but it will yield happier customers who will spend more with you, which will achieve your goal of running a more efficient business. Okay, so we're almost done. In summary, our 3 rules to running an efficient marketplace are: first, get your growth magic number over 0 by looking for opportunities to drive product-led growth. Second, if possible, try to migrate to subscription pricing to improve customer retention and lifetime value. And finally, third, invest in product-led CX and customer self-service to yield a 10x return on your CX spend. As I said at the outset, we love investing in marketplaces, and we will continue to aggressively do so. Given the pandemic, these are hard times to start and build a company, but we're confident that many great companies will emerge during this period. To put that in context, during the last recession from 2007 to 2009, many incredible marketplace companies were built, including the 4 on this slide, whose aggregate market cap is well over $100 billion. This is not unusual. History has shown that many of the best companies were started during challenging economic times. And if you look at the total value of public marketplaces in 2020, it's almost $3 trillion. That sounds like a lot, but we continue to be very bullish long-term and think we're just getting started. We're just scratching the surface on how marketplaces will change our lives, and think this next generation of marketplaces that all of you in the audience are creating will make the current crop of marketplace companies look boring by comparison. My hope is that Battery will get to serve some of you on your journey, so please don't hesitate to reach out. My contact info and the contact info of my team are on this slide, so again, don't hesitate to reach out. Thanks again for your time, and enjoy the rest of your conference. The next session will start at 9:30.